Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Hey, welcome everyone, and Joe, take it away.
Okay, thanks very much, Dave. Good morning, everyone. Just going to go for some quick updates with Strom and Atlas Sky, and then into charts of the week ahead of the big SpaceX IPO and the Stanley Cup parade down in Las Vegas, Nevada. As usual, just drawing your attention to the required disclaimer here. Strom Capital Fund 1 looks like a pretty decent year. Sounds like Mike's up over 15%, so that's pretty good. And the inception to date number just over 50%. As a reminder, we are essentially seed unit holders along with another investor group. And the thing I like about this fund is it actually kind of does seem to do its own thing and be a little bit dislocated from the stock market, certainly the S&P 500, which, is kind of what we want in alt land. This morning the ECB raised rates, and so I think it'd be interesting to see what Mike thinks on that. For that matter, it'd be interesting to see what Kevin Warsh thinks about that, along with what I understand is the Bank of Japan is sort of also getting ready to not jack up rates, but to increase short-term interest rates. So we'll see what Governor Ueda does over in Japan as well. Atlas Sky Holdings.
Hey, Joe, I just noticed something on there. I presented this last week as well, but I just noticed that he's over 5 million now. So it looks like he's added a little bit of assets, which is good news.
It is. Yeah, it is. Yeah, and that's great, actually. And we've been doing some discussions with Michael on that. So certainly giving him some coaching. He's a great PM, but promoting the business is for sure tricky. So that's great too. Atlas Sky Fund 1, this is just sort of by way of background, the fund vehicle that holds a portfolio of cash today, secured debentures. The receivables are around 230 million, and year-to-date performance is 6.1%. So this is a very consistent fund because it's essentially holding a series of secured cash today debentures that pay a fixed rate. That's pretty much it. So I guess so shifting into sort of what everybody on the planet and maybe even some people in outer space are talking about is SpaceX. So Andrew says, IPOs like SpaceX are exciting, but far from a sure thing. We were just talking, offline about just how far from a sure thing this may be. Time will tell. There's a historical IPO chart coming up, so just stay tuned for that. A lot of these high-profile debuts tend to kind of be problematic at the short end, and I was on the tail end of one of those experiences a few years ago, and I tell you that'll be the last time I go for flash and pageantry. As much as the fact that I do find Gwyneth Paltrow quite attractive, but that'll be the last time we do that. So pressure remains down. Wednesday was what the technicians called an inside day. It doesn't really provide much information, but it's funny. A couple of weeks ago, I think we were talking about one analyst. I think his name is David as well. I forget the last name, but he was talking somewhere on the order of 9,000, and now. Here we are with Andrew saying the odds of testing 7,000 are definitely there. I think the US dollar is kind of causing problems with a lot of asset classes, except for alternatives denominated in US dollars for Canadian unit holders. So let's take a look at the action here. That's quite a reversal, I would say. I mean, it's really not in the sense that it was overbought for, most of April, May, and let's say most of April and May. But that was coming off of that sort of dip down sell-off in March when the situation in the Middle East started. I'm not quite sure what the rollover is now, other than Broadcom. So these big, the Mag 7 and then the three other ones, which are Broadcom and two other companies, which I always forget. But I think Broadcom said something like we would not, like they essentially said we would keep our 26 guidance for chip sales fixed, meaning they weren't increasing it, and that got construed as this is bad. And then of course US had some pretty good job numbers come out. So that kind of, I think makes the idea of a rate cut less likely, as far as I understand it. Anyways, the S&P 500 did pop over or outside. It sort of breached this kind of longer term channel going back to October of 22, which is sort of widely regarded as the start of this bull market cycle. It's interesting because like when you breach through that upper red line, everybody's like suddenly shifts into the like uber bull camp, being like, yeah, we're going to 10,000. And then you get this rolling over back into sort of the goalposts, if you will, talking about hockey. And now it's like, oh, it's amazing how quickly sentiment or perceived feelings about the market changed. And that's why I'm not really allowed to pick stocks around here. So this is the SOX semiconductor index. It's amazing that this thing has gone as high as it has. The real sort of messaging, as usual with these charts that Andrew provides, is that lower panel, because you are getting some exhaustion in that upward price movement. So here's shifting back to the internet 2.0 with Facebook. This was a long-term chart of Facebook. So Facebook obviously turned out to be a great investment. I understand that Mark Zuckerberg and his wife own a boat that's bigger than a lot of people's boats, so they've done really well. But it did kind of get crushed right out the gate when it first debuted. And maybe Mr. Musk wants to just sort of take a look at this chart at some point. Not certainly not giving him investment advice, but that's what happened. This chart's probably got some value here. This is the percentage of NYSE listed issuers above their 50-day moving average. And because the measurement is the percentage of issuers above their 50-day moving average, the fact that this line is kind of trending lower isn't maybe sort of a resounding endorsement to go full bore into stocks. And then gold and silver really broken down here. I spent the last couple of weeks getting more educated on silver. Gold has sold off a fair bit here. I think I'm not telling you guys what to think, but I think the US dollar really has a lot to do with what you're seeing here. So that's gold. And good news is longer term, which certainly applies to our clients, is they have definitely been the beneficiaries of not only some very innovative bullion positions, but some individual gold equities, which for our clients have done extremely well. And then a few more here. Let's see. Yeah, so this is probably another more of the important charts from the deck. This is of course WTI, and it's interesting because it's gone higher, which is inflationary, particularly in terms of refined products like jet fuel, diesel. We talked about a few times, but it really there hasn't been a lot of action in oil lately, despite this sort of I'm not even sure whether there is a ceasefire. I read this morning that the U.S. launched some attacks somewhere. I really, to be honest with you, don't feel I have a good handle on this military situation, but perhaps that's why oil is sort of hanging out in this narrowing price range. And so you could see a breakout higher to that. Some of the financial planning professionals that we work with, have called me and said, what's your take or what's your call, on a deal or a ceasefire? And I just said, I just flat out don't know. So I know geopolitics is complicated, but if someone has a better opinion on that, let me know. And that's it for me, Dave.
Okay, thanks, Joe. Ken, you ready to go?
Yeah. Okay, cool. June 11th, typical weekly report, kind of an up and down week, I guess you'd say, but more down starting last Friday. Disclaimer for Canadian investors, and then same thing for US-based investors, disclaimer through the SEC. As I was saying, $7 decrease this week for the S&P 500 here, and it created a new sell signal, which is the first since March. Dropped about 3% this week, and the losses were really led by what was leading the market for a couple of months there, the Mag 7 semiconductors, and the strength was in the part that was lagging, defensive parts of the market. So a bit of a reversal this week. Vertical price objective completely reversed, so important to see there, to a bearish price, 6,800. Momentum trend reversal to end last week on the weekly basis. Overbought, oversold was the lowest since April 10th. It seems like when SpaceX announced, I think last week, they started their road show and some details on the syndication came out. I saw in my inbox. It seems like that kind of might have been where the market pivoted. We've been kind of lower since, obviously, only about a couple percentage points, but that debuts on Friday, so we'll have to see how the market prices that in. There could be some rotation of capital from these mega cap hyperscalers into SpaceX, so we could see a bit of a volatile market for the coming days. Similar moves to the NASDAQ, except a larger drop this week, 5.2%. 10 box decrease, 3 column changes, new sell signal. You can see yesterday afternoon, that's the first since 4 straight. February to March. It is at support from a few weeks ago, so important to note there. And then the overbought oversold lowest since April 10th. And a 65% reversal week over week, so important to note there. It's still up 15% year to date despite this week's weakness, so it's not like we're in a bear market or anything. The strength, I meant to delete this here. That's obviously from last week, but there seems like a theme here, a risk on reversal, with the losses really being led by semiconductors, hardware, and even the Mag 7 names. Dow Jones here actually increased week over week, so you can kind of see that value growth disparity this week. The Dow's tech and AI / growth constituents had some major weakness, but most of its defensive names had strong weeks. Complete reversal, obviously, of that growth value trend that we've been noting for recent weeks. Price objective remains bullish, overbought, oversold 27%, 9th straight week overbought, but that's still the lowest since April 10th. So that demand still impacting the Dow like it is the NASDAQ 100 and S&P 500. TSX 60 here, 1 box increase week over week to an all-time high, a new buy signal. Obviously some weakness this week with the price of gold going back to 4,200 in the miners. So we're watching that really closely. Reversal in momentum trends over the last few weeks. Overbought, oversold 37%. That's the lowest in 4 weeks. And the 12th straight week, we've been overbought. It is at a moderate level relative to US indices. So really watching the TSX here, see how the performance holds up with the kind of rotation, I'll say, in the US market. VIX 6% increase this week, 2 new buy signals you can see here, and we broke that trend line for the first time in a couple months. So I kind of was mentioning that over the last few weeks we're on this downtrend, and perhaps something would cause that to pivot. We kind of got to the lows that we saw in February before volatility really perked up, and we did get that trend break. And now the target is sitting at about 34 and change percentage, and then, which is obviously a pretty substantial increase week over week. I'll jump through these. These are just the technical indicators, but there's no changes really here. The Dow actually picked up 2 percentage points and is in official bullish territory in terms of percentage of companies trending in a positive trend. So we'll jump through that. And then the Toronto Stock Exchange, we got a move down on the percentage of positive trend, really to do with some of those miners which have been turning over the last week and a half, 2 weeks. So really watching that. And then within the asset class rankings, commodity weakness really being driven by precious metals. Energy lost a few buy signals as well. So we'll continue to watch that. Obviously some volatility in the energy trade. Will there be a peace deal? Will there not? Every news piece kind of swings the price of oil 2 to 3%. So, but we're still trading in the low 90s, I think, as of this morning. And then within the sectors, technology picked up a couple more buy signals. Really, the jump up and increase that we saw within the rankings here from the last 3 weeks, not this past week. So we'll continue to watch that. And then basic materials dropped again, really being driven by that precious metal trade. And then, as I said, kind of a rotation into defensive names. Utilities picked up buy signals this week, financials, as well as healthcare, where consumer cyclical lost a number of buy signals. So we continue to watch those. Really one of the indicators that we look at to how we're allocating within the public sector, especially in the United States. Looking here, this is Gold Trust, GLD, just spot gold. You can see we've pulled back pretty heavily. We're at the price we were at the start of December for this ETF, down year to date, 3 straight sell signals. It scores quite well because of the run we've gone on the last 18 to 24 months, so even predating this, we'll call it 2 to 3 month bear market for gold. But there seems to be a floor right now. A lot in I think April, central banks were again net buyers after being net sellers in I think February and March, or there was 2 months they were net sellers, back to being net buyers and being opportune. We think institutions are probably rotating into that. There is some uncertainty, so some investors have rotated back into US dollar denominated assets, but if that level of inflation perks up again, we could see a massive rotation back into gold. Looking here at the home builders ETF, scores basically at a 0 out of 6, so worst one of these ETFs can score at, but you can see the bounce that we've seen recently. Still down year to date. Obviously, we've seen a bit of an increase in interest rates with the rate of inflation jumping up and a number of other factors impacting that, really being driven by some economic worries in the US, but a potential, if it does break above this trend line for the first time in 6 months, a potential buying opportunity with limited resistance overhead just for a quick trade there. And then this is the tech sector, obviously been on a really strong run the past few years, to put it lightly, but really since that bottom in March, moving up by I think about 45%, looking at this chart, maybe 50% even. But we've seen a pretty substantial pullback the last week and a half, 2 weeks. And like I said, the pullback in the market is being driven by AI names. And some of those chip names like Micron and Broadcom that have just been roaring this year, and even some of the smaller chip names and a lot of the companies within that AI trade have seen a pretty substantial pullback, which is driving this pullback in the overall tech sector ETF. Well, I mean, I think it was either last week or the week before we just talked about the exposure in various markets or various indices to AI, and the tech sector was well over 50% now from a few years ago when it was closer to 10 to 15%. Looking here, this is just quarterly earnings. You can see earnings surprise percentage. We're well above the historical mean dating back to 2011. This is quarterly earnings surprise versus the historical average. And that's really being driven by a lot of these AI companies, not just semiconductor producers, but we saw some strong numbers recently from the hardware companies like Hewlett Packard, who reported really strong numbers. And I'm just saying this chart typically reverts to the mean, which could mean that we're potentially turning over the next few quarters and drawing back to this orange line, which is the 15-year average. This is just a quick chart on the US CPI from LSEG and Incrementum. Sometimes use the research, but they're just highlighting various periods in history. Basically from 1966 to 1983, you can see that blue line, the waves of inflation that we saw. They obviously picked that because it basically tracks from 2013 until now. The correlation in terms of the inflation rate is pretty identical, if you tell me. But what that would mean would be we're heading into the heaviest period of inflation if history repeats. Obviously, we'll have to see if that continues. The rate of inflation picked up last month, according to the U.S. government. We expect that probably to continue. Everyone knows that Trump doesn't want prices to increase, but if he can't put a stop to this conflict by the time the midterms come around, the Republican Party will probably be impacted pretty substantially. And then speaking of inflation, this is just the price of electricity. I just wanted to highlight the recent spike that we've seen. And I think more or less the 2024, 2025 impact here is really being driven by AI data centers, which is really impacting the overall grid and will more than likely increase prices moving forward. A couple random slides to end here, maybe out of order, but nonetheless, still some interesting information. This is the ownership of U.S. corporate equities. You can see foreign investors have pretty substantially increased their ownership, which obviously includes us as Canadians. But you can see active mutual funds has completely reverted the trend in the 90s and even from 2000 to 2010 when there were a lot of active mutual funds. Basically everything's passive. You watch any finance guru online or people online, they talk about low cost index funds, and that's because the indexes ran so well and outperformed even hedge fund managers in recent decades. There are periods, obviously, in history where indexes do not outperform and they actually run flat. Just today's investor has never seen that. So could be a breaking point here where active management really is rewarded and there's some inflows there rather than just buying and forgetting the index, especially when I think the top 10% make up about 39% of the S&P 500 right now. And once you get SpaceX in there and potentially Anthropic and potentially OpenAI next year, you could see a scenario where there's 15 to 16 companies that make up almost 50% of the S&P 500. So really concentrated by indexing, in my opinion. And then this is just an interesting graphic that I read in Bloomberg, obviously the SpaceX IPO, Joe talked about it. This is just the Musk universe. I found it interesting for those who have an interest in Elon Musk and how his companies interact with each other. But he's basically built an ecosystem where his companies operate with each other. For those of you that are interested, I'm not going to dive into how each of these companies interacts with the other, but just click pause on the back end and I'll send this around later. But speaking of the SpaceX IPO, you can see these are historical IPO valuation for kind of tech companies or revolutionary technology companies from Bloomberg, according to company filings. These are from their S1s. You can see the market value at the IPO. Obviously, SpaceX seeking a $1.8 trillion market value or an enterprise value. Last year's revenue about $18.7 billion. You can see that puts their multiple in terms of price to sales at about 96.4x. The only other company that had a larger multiple in recent years, obviously, was Rivian, the car maker, which obviously has gone on a whipsaw over the years. I'm not too sure what its market cap is sitting at, but its IPO is about 77 billion. And I remember talking about it. There were some analysts projecting it to compete one day with Tesla, but obviously that never came true. And then just ending this week off, the defensive ETF. This is the performance over the last month. Obviously, a bit of a rocky.
Ken, sorry, Rivian's down to 20 billion now. From what did it say there? 75?
Yeah, about 76.
Yeah, 76. So, yeah, so down to 20. There you go.
Yeah, and there's some dilution there. I think they did a couple raises when they were public just because they needed more working capital to produce their cars. And I'm not even sure how many cars they're producing right now on a quarterly basis. But yeah, just to show the elevated valuation. I'm not saying SpaceX won't be one of the largest companies in the world one day, just historic multiple. And then just in terms of all this high growth AI, computer hardware, AI semiconductor chips, and now SpaceX, just looking at defensive names, that's what we're looking at. We used to own this within the relative strength platform that we operate, but this is just the TSX Consumer Staples ETF. We own, I looked at the constituents, several of the largest holdings in this ETF, but trades at a very reasonable multiple compared to especially some of the US defensive names, up over 6% basically over the last month, especially with the market volatility. We're not seeing a rotation out of names here, and we're going to continue, I think, to rotate some capital into some of these defensive names, especially where we're at in the market right now. And I think that's it for me today. Yeah.
Hey, before you hang up there, Ken, I wanted to do on the front end the weekly beacon that you finished. That's coming out tomorrow morning. So let me just put it on the screen here. And you can run us through what you've covered. People sort of a sneak preview.
Yeah, I have it open if you want me to just quickly share.
Okay, you can do it. Great. Go for it.
Yeah, so I guess it's on a 2-page, but that's not a problem. Yeah, so I talked just about SpaceX and valuation and some of the people and groups that are bears. Morningstar, interesting enough, has a valuation of it in the $780 billion range, which is well below obviously the price that Elon Musk is seeking. And then I talked about some of the larger returns that will occur if SpaceX IPOs at 1.8 trillion. Google invested about 4 billion back in the day I think Alphabet, yeah, so they participated twice. Their first investment was at a $12 billion valuation. I'm not sure what their second one is, but they're sitting on about, I think, according to this graphic, 200 billion. The Ontario Teachers Pension Plan obviously sitting on a pretty substantial gain, I think about 12 billion in terms of with where their value could be. Talking about Elon Musk's ownership of the company, and then talked about OpenAI, who filed its S1 this week, and Anthropic, who already has, and just these mega IPOs, something we've never seen. And then when you add on the raise by Alphabet 2 weeks ago, pretty substantial amount of money that's being raised, and you don't often see that at market. Obviously, bottoms, it occurs usually at market tops. But beyond the IPO market, just looking at China and their government's commitment to the AI industry, which is officially basically locking out NVIDIA. Jensen Huang has kind of been saying this in interviews, but officially this week with China's bill, they're spending about $295 billion, a little less than the U.S. government over the that has committed to the AI industry, but basically I think 80% of the chips have to be sourced from Chinese companies, so really locks out the likes of AMD and NVIDIA. And then looking at some quick research from Bank of America, just they have 10 bear market signals, and right now 7 of them are flashing. So just something interesting there to share with our network. And then last one, just talking about inflation, the rate of inflation picking up this past month, how that's been impacted by the conflict in Iran, energy markets, and how global oil inventories are really kind of keeping a lid on the price of oil, and how long that might last, according to some analysis, including some research from Carlisle, which I used this week. And I think that's it. Yeah, so that's basically it for this week.
Okay, great. Thanks. Okay, I don't have much today, so I'll be briefer than normal. So nothing from Michael Kulba, and Joe covered him again about just his results. Here we go here.
Morning, everybody. My name is Miles Clark. I'll be going through the morning brief for today. Happy Thursday. In terms of performance yesterday, mostly negative across the board. We saw markets reversing lower throughout the day there. S&P 500 off around 1.62%, just over 0.5%. Equal weighted S&P 500 almost equally as bad. They're down around 1 1/3. A couple names in positive territory, that being crude oil and the US dollar, eking out a 4 basis point gain. And towards the downside, we saw the NASDAQ composite and gold slide over 3.5%. In terms of notable chart action, most of the names moving lower here. The Dow Jones .DJIA returning to a column of O's, although it does maintain its string of 5 consecutive buy signals, a positive trend, and has some support just above the middle of the trading band there around 49,400. So technical picture on this side of things is still relatively constructive. I will note part of that argument will be the upside has been less intense, so we're more nearby to support than some of the other major indices. So just keep that in mind. And of course, on more major pullbacks, we'd be looking towards that kind of 47,800 mark and our current bullish support line. Now, the NASDAQ composite, as I mentioned, although it was down for the day, did open high enough at least, or see an intraday high enough to reverse back up into X's up around that 25,600 mark there. Now, again, this is going to be, offering some support nearby, just above the middle of the trading band, but you'll see we are pretty close to reversing back down. So we'll certainly have to watch developments here, see if we get a reversal back down on our default chart here. But of course, if we can't sustain it, looking to get back up to those relative highs that are up around the top of the trading band from earlier in 2026. The Russell 2000 getting a reversal back down as small caps struggled a bit yesterday. Still up around 14.25% so far this year, but we do see now a lower top coming off of those all-time highs up around that 2940 mark. So keep this in mind. Small caps still have a relatively strong picture as we have some support just around the middle of the trading band and above that old resistance from earlier in 2026. But again, reversals always something that you want to keep your eye out on. Gold, our biggest loser for the day. You and I have talked about this on pretty much every morning video that I've done over the last month or so. We've seen just a continual series of lower highs. Essentially has a technical picture only a mother could love here. We are now heavily oversold and nearing on those lows from 2026 and around that bullish support line down below around 4,000. So we talked about a journey to those levels not being out of the question. Got there a little bit sooner than I might have expected, but point is now down at the bottom of the trading band looking for bounces and of course monitoring very closely or trimming your more precious metals exposure, as need be. Next, crude oil up around 2% yesterday, getting a reversal back up into X's here. Although I will note, as we talked about on, I think it was Tuesday morning, a series of lower highs, really kind of squeezing us in between, let's call it a point of resistance around 105 to 110, and some notable support down there in the mid to upper 70s. So those will be a couple landmarks I'm watching, as well as that bearish resistance line up above around 96. Next, I do want to mention a more sensitive chart that I take a look at every once in a while to judge the health of momentum. Take a look at MTUM versus SPLV. So this is a momentum versus low vol, and it's on a 1% chart, so it's obviously very sensitive, or more sensitive, and will move around a little bit more. But this returned to a sell signal. As I said, otherwise, low vol names have taken over some control on this sensitive chart. That's the first time that we moved to a sell signal since late 2025, and the first time we were on a sell signal since around April of this year. So just keep an eye out on this. A lot of the semiconductor weakness has been kind of a headwind for momentum strategies, or at least broader momentum strategies. So keep an eye out on this. And then just a couple stocks I want to mention here. Royal Caribbean RCL was off around 5% yesterday. It is a 2 for 5er. And we have seen it post a series of, essentially failed breakouts where we were unable to sustain action, in a positive trend. So returning to a sell signal yesterday, moving back down below the middle of the trading band, a journey, or may I say cruise, back down to those 2026 lows around that 236 mark would not be out of the question. And just lastly, to give you a strong option to close out the day, Ventas VTR is a 5 for 5er. Up around 9% so far this year, returning to a buy signal on its default chart. A nice positive trend line ushering this thing higher since late 2023, early 2024. And from here, looking to attack those all-time highs up around 91 on our default chart. All right, that's going to do it for me here. I'll be back again.
Yeah, I don't know Ventas. Does anybody know what they do? I'll look it up later. Okay, I'll do the watch list after just looking at what's gone on in the markets. Here's a notable change. The venture exchange has gone a negative for the year after having some bad weekly and monthlies. So that's the small microcap market in Canada is under pressure again after having a very good run there, with keeping up to those markets. But yeah, it's just come under pressure. Everything else, there's lots more red here. So Germany's gone into the red. I saw some things on Bloomberg this morning with some rate spikes in Germany and Italy. So inflation's proving to be a problem there. Australia's gone slightly negative, and India continues to be negative. All right, that's the dog. 1 second. Apologies. Okay, finishing off here. Yeah, so markets are toing and froing, and some turnover there. Crude still strong year to date. Nat gas positive, but coming under pressure lately. We've heard lots about gold. It's definitely taking more than a pause here. Very hard to trade around though, unless you're just trading for your own account. Yeah. And then on the as always on the Canada US dollar, I'll do that off the point figure, same thing as interest rates. And so let me go back to that. So yeah, no change in the Canada US dollar at 72 cents. Same vertical price objectives, both in the short and the long term. So nothing's changed there. Nothing's changed in the US dollar spot index, although it showed some strength on that analyst at NASDAQ Dorsey Wright's brief report, but I think it was nothing here. Let me just pull it up. Yeah, so really it's done nothing year to date. It's been sort of flat at just a little under 100. Okay, and then finishing up here. So crude oil is at 90, measures down to 82. And nat gas shows some upside little bit there, and as do the producers. Copper looks to be peaking out for the short term. Uranium, that's reversed itself, whereas the price objectives are lower now in that space. And that analyst, Dorsey Wright analyst, showed gold on a continuous basis, which is all the futures. So yeah, that's definitely showing something just on what's happening in the options market. But the gold price itself sort of flat year to date, and has a flat target as well. Now the gold bug index, that's changed. That's pointing down now for the producers, as are the majors and the juniors. So that's completely reversed itself week over week. Silver flat, and then the silver producers look like they're down. So yeah, money's getting out of the precious metal space and chasing back into technology. No one wants to miss out on the technology boom, but we'll continue to play in our private technology plays. Platinum flat, Bitcoin still looks like a disaster there, measuring down to 22,000, and the entire crypto space, completely. People have given up. No one cares anymore. Sure, Sean, I'll have some more comments to say about that. And finishing up here on interest rates, yeah, so it looks like at the short end, we're over 4% now, measuring up quite a bit higher to 575. So the market's moving rates up. Also on the 5-year from 4.2 up to 5.5 and a quarter. And the 10-year, same thing from 4.5 up to almost 5. And then finally, the 30-year is well over 5% now, or not well, it's over 5%, but it measures up to over 6.2%. So inflation is still in the cards. Ken, that one slide you showed halfway through your presentation, can you send that out to everybody? The one just how we're tracking the 60s and 70s in terms of inflation.
Yeah.
To send that to David Hunter and some others. And that's it for me. So Sean, you want to take it from here?
Yeah, I'm getting set up here. Okay, so it's my macro overview, not investing advice, but take it for what it's worth. My positioning right now, lower capital exposure due to the Iran war. It's like risk on, risk off. You know, valuations are pretty high, but that's not a reason not to invest if we're just going to start printing money like crazy. I've got long biased exposures through AI, still, hanging on to some silver, copper, defense, bit of a debasement trade, tiny bit of crypto exposure, mainly through residual holding or tiny holding in Coinbase. I've done pretty well with some hedges in the last week, I guess, as you could imagine, mainly by shorting futures, although I'm starting to look at some put spreads as plays. The crypto market, which I guess I'm known for, is fragile with a risk of breaking lower. As Dave points out, it could fall a lot lower. Like I'm thinking 35,000 to 45,000 on Bitcoin before we see a turn, which I expect to come in the fall. When we take a look at asset classes, the major asset classes, the US dollar is up. So as a contra asset to every transaction that we do, basically as expected, everything else is down. But it is a little surprising, gold got hammered actually more than Bitcoin in the past week. Ether is a disaster. Tom Lee looks like a fool for backing the Bitmine with billions of dollars of losses on their book. Oil is down over the last week, but seems to be kind of hanging out here, even though the shooting war is about to start again, it seems. Economics, not really any changes there. Growth is expected to be 3.3% by the Atlanta Fed. Unemployment's in line. CPI came in, I think fairly hot and went, what company can be, so far off their sales projections, for example, and still survive without the board taking action? And yet here we have the Federal Reserve just, not even getting close to their target inflation. Unemployment is good. That's their other mandate. And then I guess market stability, they're knocking it out of the park on that at the moment. The US dollar, as people have noted, much stronger in last week, like 1% up on the US dollar. This is the largest asset in the world. So when it moves by 1%, it has impact. That being said, we've just been going through a year of chop. There's been the flight to safety due to the Russian conflict with Ukraine, the Iranian war. We're hearing rumors of a dollar shortage in emerging markets, and these pretty decent rates in the United States are drawing US dollars in to take advantage of those rates. When we look at the yen, another major currency, and basically for me, a bellwether of where many Western economies are heading in, this demographic crisis that we're all heading into, where, the dependency ratio is being turned upside down. We're having people living longer and fewer workers to support them. I'm expecting another Bank of Japan intervention. And if they don't do it, we are going to see a material break in one of the major currencies in the world of, we could see it move by 3 to 5% in a single week. Gold's in a bear market, as everybody has noted on the call so far. We've got negative momentum. You could see the waves of red in my in the heat map. We're 25% off the high in February. Rates are attractive, so there's kind of a cost to owning gold for storage, etc. It doesn't pay any yield, and the U.S. right now is not debasing their currency actively. So the call to hold gold is a little bit tougher than it was. There's strong operating margins in many of the miners. However, like the juniors are off, as an aggregate index, just use GDXJ. They're off 37 from the February highs. Silver, not looking good either, down 43% from the highs. When it was going parabolic, we were calling that out. Things in finance just, parabolic moves don't resolve by continuing or going sideways. So we've seen this come off and we're seeing a sideways market. I expect solar demand to just continue to grow and be a demand stimulus for silver long term. But right now it's suffering the same fate as gold. Oil, it's all about the war. At the end of the day, look, Israel started the war. They dragged the US into it. They're not getting what they want. So I don't see a resolution anytime soon. And every time we think that they're satisfied, they just go and attack Hezbollah and Lebanon even harder and let everybody know that they have to be dealt with. So this is a global tax on consumption, and it's starting to bite. Many of the companies that produce things from oil derivatives had 2 to 3 months of supply. Well, that's now. Like, we're now getting to the point where their inventories of what they need to manufacture are starting to dwindle. I still keep hearing rumors that actual physical spot oil is trading like 120, 130. But I don't have a good confirmation of that, so don't quote me on that. But if these inventory stories are correct, we should expect the bite to happen now. Rates and credit, pretty boring. Like nothing has really changed. The yield curve is out one. Mortgage rates have come in a little bit. High yield spreads have come in a little bit. Still a lot of issues in credit. Here we see the 2-year rate, the US, 2-year versus Fed funds. Typically, the 2-year leads things higher. Quite notably, look at 2014 through 2016. The 2-year trended up, and then the Fed funds followed it all the way up to, like 2.5% when the 2-year was hitting 3%. We're starting to see the 2-year head higher on inflation expectations. The Fed doesn't want to see inflation expectations get entrenched. We're probably going to hear the word transitory soon out of Warsh, and I'm hearing that he's trying to figure out how to narrow the definitions of what goes into inflation even further so that he has some justification potentially to cut rates. But I mean, that would be pretty insane to me right now. Equity, we've seen sentiment move from neutral to fear, despite being near all-time highs. This is a pretty material shift in sentiment in my mind. And yet the VIX term structure is essentially still normal with like a reasonable, like 20 is kind of like a threshold for the VIX of being supportive of equity market return momentum and getting a little fuzzy. So I'd say things are getting a little fuzzy right now, but the earnings trend, as spoken about earlier, is still positive. But right now, sentiment as CNN measures it, and I have to say, I think they did a good job with this index, is reflecting fear. Doing some work on creating an equity regime model, looking at basically 20 years of triple Q returns on a daily basis. Right now, by the model as it's created, it says we are in a bull market, day 41 of the bull market after the recent sell-off. There's been no change. The bull market is the same as it was the day before. here's a brief, a brief description of the model. It's a 4-signal snapshot that's run through basically a neural net. We've got, if we look at historically, what are the forward returns in a bull regime over 60 days, 3 months? It's about 3.37%. That is fantastic, frankly. And 72% of the time, it's resulted in positive returns. The interquartile range you can see is like minus 60 basis points to positive 786. So if this regime holds and we still are in an overall bull trending market as defined in this regime model, it looks good to stay long equity despite this current. Here you can see a visualization of the characterization of bull, sideways, and bear markets. I guess if there's one thing that this chart shows us is most of the time you want to be long. We have some dips, but especially in technology, humans advance. Turn that the same data set into a Markov model, which creates a transition matrix. It says how likely are we to stay in the current regime? And so we've got the bull, sideways, and bear market. Statistically, you don't jump from a bull to a bear. You go through sideways, and you can see different horizons. For example, a month ahead, 65% likelihood that we'll still be in a bull market, but 23% potential will be sideways, and a 12.5% chance that we could be in a bear market. So this is nascent. I'm using this to think about how I'm making index-based bets. What we're seeing with the S&P, a bit of faltering right now. Like you can see, we're still well above the slower moving averages, the red and the green. The heat map is still clear. We're seeing a little bit of red come into, it was clear. We're seeing some red come into it, where 6 of the 8 indicators are now showing red, and it goes from top to bottom. The top, the blue, are the shortest, and the green are, for example, 60-day moving averages. So typically you get the red coming in at the top and filling down. If you've got all 8 indicators off, it's characterizing a market of basically a 0 or lower Sharpe ratio expectation. We're seeing that softness. Is the war on? Is it off? We're seeing oil prices starting to bite. When we look at the volume distribution that's on the vertical axis with the bar chart there, that's showing there was a ton of volume around 6,900, and you would consider that kind of a level of support, and that's about 5% below where we are right now. So this slide has been on for about a month now. Hedge some now. Last week was a good week for my hedges, and then I've updated what I think people should consider. A put spread or a 1 to 3% SPY put at for 3 months at 690. We're still at an extraordinary Sharpe ratio for the past 60 days. Like we're in the well past the 90th percentile of what this market has ever done on a risk return basis. Crypto, it's bad. Well, it's gotten worse. This is a broken risk asset. Nobody needs it. Nobody cares about it right now. My direct holdings are really very low compared to where I've ever been in the past. The Clarity Act, supposedly July 4th, everything comes into effect, but we'll see. And we need Coinbase to get sorted out with US banking infrastructure. We're in a Bitcoin bear market. Who needs Bitcoin? The trend is lower. I just don't know what to say. People call me all the time, and I just don't see support for this asset in any way, shape, or form right now. I had great expectations that Apple would get their act together on AI and maybe announce a rational lineup for their chip and computer technologies, but they just didn't. It was pretty disappointing. At the end of the day, I said, own it. I was wrong, and I'm out. This company it just could not be moving slower. And to that, here's Tim Cook. This year's Apple's new iPhone sets the standard for the camera phone. That's probably, all we're going to see out of these guys is just hardware improvements to the point of things getting a little ridiculous. And because SpaceX is so popular topical right now, here's what I think Elon Musk is heading towards with shareholders, portfolio managers, and the board of directors just all bowing to our new corporate monarch. That's it for me.
I thought you said you hadn't built that cartoon yet, but I guess you had.
I knocked it out while we were talking.
You did? Okay. Interesting. Yeah. Okay. Anybody have anything else? Gilbert's away at a conference. Looks like Chris Curry's not here. And Paul Beatty's not here. So anybody have anything else they want to add before we sign off? Okay. Have a good day. Bye for now.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.